Hey, what's going on, guys, and welcome back to my channel. In this video, I'm doing a 25-week update on my M1 Finance portfolio. So this portfolio is called Unicorn. Within Unicorn, I have 3 slices. One is my dividend growth slice, one is my monthly high dividend slice, and one is my value slice. And before I jump into each of the individual slices, you can see the performance right here. But overall, my performance in 25 weeks has been plus $1,300, or a return of 9.27%. A lot of this does have to do with the market performing so well over the past few weeks. If you guys are aware, the S&P 500 has made new all-time highs and basically has been skyrocketing for the past few weeks as I'm filming this video. And so obviously my account is going to benefit from that, but even including that, I think there are some few key features and takeaways that I try to do when I'm investing in stocks for the long term. So let's go ahead and talk about some of those takeaways. First, let's talk about my dividend growth slice. So dividend growth is exactly what it sounds like. It's companies that consistently increase their dividends every single year. Some of them have been doing them for over 50 years, like let's say 3M. But being a dividend aristocrat or a dividend king isn't necessarily the only prerequisite of being in this portfolio. So the first thing I want to talk about is my investing philosophy. So I basically have a basket of companies. There's anywhere from 20 to 30 companies at any given time within this portfolio. However, I try not to make too many changes. The reason why you see this type of portfolio and not something that's divided by sector, for example, if you guys have seen Joseph Carlson's videos, you know that he made that very popular, which is basically having different slices, each one dedicated to a different sector. The reason why I have this instead is because I like these companies almost equally. I mean, obviously I'm going to have some favorites, but for the most part, I try to be as unbiased as possible with my investment strategy. And given that I like these companies and want to invest in them at any given time, if they're showing weakness, well, that's basically the only prerequisite I have is if they're showing weakness, I want to invest in the companies that are showing weakness. And I don't want to wait for a sector-wide hit. For example, if I sort by my gain, I know that I'm down the most on these companies that are showing a negative return, and I can specifically invest in them because they're red, and I don't have to wait for, let's say, the sector that McDonald's is in or the sector that Colgate is in before money starts flowing into each of these stocks. And most of the time, when you see a stock doing poorly, generally the sector will do poorly as well. However, there's going to be all sorts of overperformances and underperformances when it comes to stocks in each sector. So just because one stock in a sector is doing bad doesn't mean the entire sector will do bad. And the second point I want to make here is that I try not to pick favorites. I mean, obviously I'm a human being, so I am going to like some of these stocks more than others. Just naturally, I'm going to be attracted to some of their business models and some of their products that I've been using. You know, I've been eating Special K cereal since I was a kid. But for the most part, I try to leave that at the front door. And I basically just try to invest in companies that are doing, or basically not doing so well over the past week or over the past month. I try to funnel my money there. However, there is something else I want to point out. So if I sort by value, basically there are some companies that I thought were showing awesome buying opportunities like 3M, Johnson & Johnson, AbbVie, and Caterpillar. And these are basically my core holdings. Anything that has a 5% allocation or above, I would consider to be my core holdings, and I want most of my money going there right now. And so let me go ahead and actually filter by target just so it's a little cleaner. So we basically see 3M, Johnson & Johnson, A.O. Smith, AbbVie, Caterpillar, and Roper Technologies in no particular order to be my core holdings. Now, because of my aggressive strategy in some of these that were showing good buying opportunities like AbbVie or Caterpillar, I'm already being rewarded on those. On AbbVie, I'm up 44%, and on Caterpillar, I'm up 24%. I do think that 3M, Johnson & Johnson, and A.O. Smith and Roper Technologies will take off at some point. It's just a matter of trying to get as much money into them as possible. The other thing I want to highlight is I'm basically investing in companies that I think represents American business at large. American business, American consumerism, and American capitalism. And so basically I invest in companies that I believe to be strong leaders within their sector. I think they have strong moats, and basically all the basic investing fundamental philosophies that we want to have. And yeah, basically I'm bullish on America. And so McDonald's, I think, is the most popular and best fast food company out there that I want to invest my money in. Within telecom, we have AT&T and Verizon, and AT&T is becoming more than just a telecom company. They're also purchasing media companies like Time Warner Cable, and Time Warner Cable owns, TNT and HBO. I also invest in some of the largest banks in the world, like Bank of America and Wells Fargo. I invest in the best home improvement store in the world, which is Home Depot, in my honest opinion. I invest in the best cereal brands in the world, like Kellogg's and General Mills, for example. I'm investing in the best beverages in the world, like Pepsi and Coca-Cola. And so the list goes on and on. I try to invest in some of the best companies, in my opinion. A lot of times that means just investing in dividend aristocrats, which are companies that consistently increase their dividend yields and have been doing it for at least 25 years. Again, I'm not sure what the audience of my videos are, whether people are more advanced or not so advanced, or maybe beginners. But either way, I think regardless of what stage you are at investing, it's important to have like a core philosophy. And so that's my dividend growth slice. Let's talk about my value slice next, because my value slice is basically me doing my best hedge fund manager impression, and I'm trying to find companies that are undervalued at the moment. Value investing is a pretty solid strategy. It's basically investing in companies that you think are trading at below what they should be trading at. And so if I take a look at this portfolio and I sort by return, we can see that I'm only down on about a little less than half of these. But for the most part, each of these companies is meant to be a little bit speculative. I mean, there are some blue chips like United Health and Cardinal Health and Altria, but there are some companies that people haven't really heard of. It's definitely a little bit more biased to the healthcare sector. I have like Gilead Sciences, and I have Allergan, and I have Cardinal Health, and I have United Health Group, which is kind of like financials, kind of healthcare all in one. And the reason why I'm leaning more towards that is because I think there's a lot of healthcare stocks that are being hit right now, and healthcare is a very large industry, so I'm expecting some more growth going forward. And healthcare has generally performed well since the 2009 recession, but I would say over the past few years, maybe 2 to 3 years, it hasn't performed too well. So I'm just looking within that sector and trying to find the value. And the last portfolio is my monthly high dividend pie. I'm currently up $341, whereas most of that gain is actually through earned dividends, which is no surprise because it is a dividend pie. I have Gain, Gladstone, Realty Income, SPHD, Main Street Capital, PTY, Stag, and LTC, where I'm only down on LTC. And this is basically my tank. This is probably one of my most reliable and stable pies. I think the dividend yield is currently around 6.5%, maybe even 7% on this one alone. And I expect to get income every single month from this pie. I think I get maybe around $40, but we can go ahead and check right now. So this is my activity tab. I'm only showing the dividends right now. And clearly we could see some of the more quarterly payers like Caterpillar paid me a really nice $4. Texas Instruments isn't the best payer. They paid me about $1.83. Their dividend yield is currently below 2%. A.O. Smith has a pretty low dividend yield, but they're increasing it pretty rapidly. So they paid me over $2. Realty Income paid me close to $2.50, and this is a monthly payer. Procter & Gamble paid me $2, solid blue chip company. And then these are my monthly payers, Main Street Capital, Stag Industrial. And what I'm showing right now is companies that pay in the middle of the month, which is Realty Income, Main, Stag. And then obviously you can see like AbbVie paid a monster dividend of $5, love AbbVie. Clorox paid me nearly $3. And I love seeing my products, by the way. Like I have Clorox products in my house. And whenever I see other Clorox products, I'm just like, man, I love that company. And I'm actually starting to buy t-shirts with the companies that I invest in. I'll probably wear them more often for my videos. But anyway, getting off topic here. Now we can move on to some of the companies that pay at the beginning of the month. So that's going to include things like PTY, which paid a really nice, close to $6. And that's every single month from PTY, which I think is awesome. And then continuing on to the beginning and end of the month, on October 31st, I got about $4.50 from Gain, which is Gladstone Investment Corporation. I got over $5 from Glad, which is also a Gladstone company, but this is Gladstone Capital Corporation. And I got $3 from LTC Properties, which is a healthcare slash I guess retirement home REIT. And then I got $3.49 from SPHD. I got 75 cents, but this is like leftover from Glad as well. And then the last one, which is a monster, close to $10 from GOF. So I actually sold GOF, so this $10 that I used to be getting from them is going to be redistributed throughout the rest of the high dividend portfolio. And so I'm not going to be getting the same yield. So instead of getting $10 from GOF, I might get like $7 from the rest of my other companies. But I just didn't like it for the long term, and for the most part, I want my portfolio to be as autopilot as possible. I don't want to have to keep on paying attention to it. And GOF, I just didn't feel confident that it would be at least going sideways in the long run. I think it has like a slightly downwards tilt to it, and so that's not really hands off to me. And so these are the previous month's dividend yields. I have Cardinal Health, which obviously I don't have that much money in, but still getting a nice dividend yield, and then Altria, which is just awesome, giving me close to $3. So yeah, these are basically my dividends over the past month. And I mean, I love the monthly payers because of that reliable income. I want to wrap up this video by going back to my dividend growth pie, and what I did was I sorted by my total gain and total return. And so if I take a look at, let's say, the top 10 holdings sorted by performance, there's basically a mix of companies that I would say I invested in because I thought they were values. And then the other companies are companies that are just basically in uptrends and are in really strong trends, and they're also doing pretty well. So it goes to show that, you know, as much as it's important to try to invest in value as much as possible and try to get the most bang for your buck, there are companies that are going to be in just strong trends and that are going to continue going up, even though they've gone up a lot in the past couple years, let's say. And those companies that have gone up, like let's say like Costco, for example, if I take a look at Costco over the past 5 years, Costco has been killing it since 2017, and it's going to be really hard to try to find the optimal buying opportunity. But if you're starting out your portfolios, you don't want to miss out on investing on a high quality company. In this example, I'm giving Costco, just because of how much it's gone up a lot in the past, 2 years, for example. And investing in strictly value, I think, is a mistake that some investors can make, even though I think it's important to try to get the most bang for your buck. And like, for example, like I am going to invest in companies like Walgreens Boots Alliance, if we can go ahead and find it. WBA, boom, I'm up 18% on WBA. And this is definitely a company that I was extremely enticed by because it is a dividend aristocrat, because it's showing such a strong dip right now. We can go ahead and take a look at it. We can see that its all-time high is currently nearly around $96, where the low made recently in 2019 is around $50. And this is actually, I was actually able to get into Walgreens Boots Alliance before it took off. So that's why I'm up pretty nice on it. And so yeah, I invested in WBA because of its value status and nothing more. I didn't actually like the company's financials as much as any other company, but I did invest in it because the margin for error was so great. I mean, how wrong could I possibly be on the company if I'm investing 50% below its all-time highs, and it has aristocrat status? And so I am going to be a little bit more biased to value companies, but if I'm starting out a portfolio and I want to hold this thing for the long term, I don't care if it's run up a lot in the past 2 years. I mean, I'm not going to miss out on investing in a Target, or let's say, what's another company? Let's say Costco, I already gave that example. Let's say Procter & Gamble, perfect example. I'm not going to miss this opportunity just because of its performance. And just to summarize this video, I want to go over some of my key takeaways, especially for new investors, and some of the tips that I would have. So basically, when you have a basket of, let's say, 20 to 30 companies that you would consider to be high quality, and you actually like each of these companies, then it becomes really easy to invest in those that are undervalued, because you basically create like an artificial watch list. Like if you check your portfolio every single week or every month, for example, and you see that, oh, I'm actually down on this company, or this company actually went down a lot over the past couple weeks, then that's a good signal that you may want to start funneling your money into that company. And it's really just about getting the most bang for your buck. And in my opinion, if you do want to get the most bang for your buck, then that's the strategy that I would employ. And the other thing is, if you're just starting out your portfolio and there are some companies that have gone up a lot over the past, let's say 2 years or something like that, then over the long run, to be honest, it doesn't really matter if you feel like you missed out on that run, because the longer that you invest, the less that those, smaller fluctuations matter. If you feel like, oh shoot, I got into this company, let's say 15% too late, I promise you that the longer that you invest, the less that any of that stuff matters. And so that's basically my tips for new investors that are starting out their portfolios. So yeah, those are my tips, and thank you guys for watching, and I'll see you guys